we have a massive housing crisis. In California, I think the average renter pays 52% of their income towards rent.
It is almost anemic, the amount of activity that we're getting. And these are 6.5, 7 cap deals that genuinely we're hearing crickets on.
My sense would be things will change. Things are not static. When you look at that basis, I go, I don't know where you can get such a discount to replacement cost.
California is approving new housing permits at a much lower rate.
What you're really doing is you're impeding any new supply, because why would a developer build in Hollywood when they can buy for that cheap?
John, welcome to the podcast.
Thank you very much for having me.
Appreciate you being here.
Yeah,
so,
of course.
Tell me how you buy this building, because I heard there's some bonds involved.
Yes. Yeah. It's a very interesting story. So,
and for context, real quick, we're sitting in your building.
Yes.
In Long Beach.
So we're in downtown Long Beach. We're at a project called Ocean Air. Lennar's Multifamily Group built this project. It's 216 units, right on Ocean, kind of in the heart of downtown Long Beach. As we were talking before the podcast, I mean, this is really sort of main and main because we're right near Pine. Ocean and Pine is sort of the main and main of Long Beach. Great asset, great location. Lennar built a beautiful asset. So I'll try to make a long story short. So in the let's call it February of 2020, right before COVID hit, there was a group up in Northern California that was acquiring existing market rate housing in partnerships with what we would call joint powers authorities. So these are governmental agencies in California that we had dealt with before because we do a lot in the affordable housing development space. Mm-hmm. And so a group up in Northern California had figured out that if you had a joint powers authority take title to an asset based on California law, the Constitution of the state of California, you can get a property tax exemption. And so they figured out a structure where you could raise tax-exempt municipal bonds to acquire existing market rate housing in a structure where the joint powers authority would take title to the asset. The city would have to opt into this program, but you could sell those bonds and get a property tax exemption, and thereby you would finance 100% of your acquisition of the project. And through that mechanism, you would dramatically lower your operating expenses. You'd have no equity, so you'd lower your costs, mm-hmm. right? Let's call it the cost to the cost of the capital, and then you could lower rents, and so you could deed restrict rents to between 61 and 120% of the average median income. And so, I mean, as you well know, in California, we have a massive housing crisis, right?
Sure.
In California, I think the average renter pays 52% of their income towards rent, which is, the HUD would tell you want to be between 30 and 35%.
Yeah.
So it's a massive issue. Massive issue. We never build enough housing in California to keep up with demand that we've had. And so we heard about this program through a broker. A broker had called us.
Good for him, man.
And had said, hey, they actually were the broker who sold the project.
Okay.
And said, hey, look, we did this deal. We have no idea how this group put together this capital. We kind of don't know how it all worked. But my business partner is really an expert in affordable housing finance.
Yeah.
And said, you and John are pretty smart. Maybe you can figure this out. And so to use a basketball analogy, we went into the lab, my partner specifically, and then COVID hit. And so we had a lot more free time because we're all at home. So really went into the lab, reverse engineering how these projects worked, did a bunch of research on a couple projects in Northern California that had closed. And we sort of put the pieces together. And it was a really good blend for us because we had done a lot of market rate housing at that point. We had done a lot of commercial acquisitions at that point. And we had done a lot of affordable housing. And these workforce housing projects, they had a very nice blend of affordable housing and market rate housing. Because you were buying market rate housing, so you had to understand how market rate housing works, how market rate sellers work, but then you were also converting it to workforce, not affordable. Mm-hmm. Affordable housing is really 61% of area median incomes and below. Mm-hmm. This is really targeting the missing middle, right? People who make too much to qualify for affordable housing, but don't make enough to afford market rents. And so we spent a bunch of time figuring it out. We got connected to CSCDA, who is a joint powers authority in California, who was thinking about doing these programs. We had done work with them on affordable housing, bond financing in the past. They connected us to Goldman Sachs, who became our bond underwriter, and we started underwriting projects. We had a relationship here with the seller, Lennar, and we, had a great relationship with the city of Long Beach. City of Long Beach had a mandate from a housing report they'd put out a couple years earlier to create more workforce housing. And so we were able to put the building under contract, go through the city, get their approval to join the JPA and participate in this program. And then we went through a process with Goldman Sachs to go sell the bonds for this. And so we acquired it with 100% financing. We get paid fees on the deal. Our technical term is what they call project administrator.
Okay.
So it's that's kind of how it all came
Why
together.
couldn't Lennar do that?
So the bond investors traditionally like to know that there is a separate group coming in, and they want to make sure that there's an appraisal done, that there's a new group coming in to acquire it.
Interesting.
And Lennar would need to partner with a government entity. And those government entities want to see a new group come in. So usually the existing developers couldn't do that themselves.
Got it. Okay. And what's stopping you from doing this with every deal?
So I would say interest rates. So clearly, part of the reason that this worked is I think our pricing on our bonds here we got 100% financing at about 3.75%. If you blend in the total coupon rate of the 35-year tax-exempt bonds. Because at the time, these are unrated, high yield bonds. So but they're tax exempt, right? So when you look at that space, this was at the time when treasuries were nothing, right? And so we were offering a premium to that, and there was a lot of liquidity in the market. In the bond markets, there's been less liquidity as of late. And the other issue is that, those bond investors, which the groups who invested in this are the really large bond investors that exist in the marketplace. Vanguard, Franklin, Nuveen, PIMCO, these groups that have huge portfolios of bonds. And what they liked about these deals is they were higher yielding. And so they can blend that with what was really anemic rates for rated bonds, which would be treasuries and California bonds, whatnot, governmental bonds. And so, now as those rates have risen, the rates on these have risen as well. And so it's just not financially feasible because, candidly, at the time we were doing this, specifically, like if you looked at this project, market rate buyers were not really interested in institutional California product back in, call it the second half of 2020 through the first half of 21.
Yeah.
This is when we had a lot of the COVID eviction moratoriums. It was kind of a choppy market. And so we buy on a 35-year horizon with these deals. And so we were able to underwrite past what we thought was going to be a short-term situation. And so the market rate buyers really weren't there. Market rate buyers came back. Deals got harder to pencil.
Yeah.
And even though pricing is down, kind of throughout Southern California, when you look at the fundamentals of Southern California, the multifamily markets are still very strong. And so the deals, unfortunately, just don't pencil right now.
So you said the deals, the fundamentals are strong.
Yes.
But yet so many people don't want to invest in California anymore.
Yeah.
Why do you think that's the case?
That's a really interesting question. I think to me, the regulatory environment, and here's what I would tell you. If you look at San Diego, San Diego has had strong activity. Pricing is still very strong. There's still a lot of interest there. Orange County, there was a large project that just sold to an institutional buyer in Irvine for a 4 cap, right? All cash. And so I would tell you that I think when you hear, and you know this from living here, it's hard for people outside of California to understand, like, there's a whole host of different places in California. I think institutional capital doesn't necessarily want to be in LA County, San Francisco County, and maybe you'd also kind of lump in Oakland there. I think institutional capital, when you look at the landscape, will go to Orange County. They'll go to the Inland Empire. They'll go to San Diego. They'll go to Ventura County, right? They'll go to these other markets. And I think a lot of it's political risk. So I think what San Francisco, some of the markets up in the Bay Area, some of the counties up there, LA County did regarding the eviction moratoriums, it created massive issues because what it did is it dramatically increased risk from an NOI perspective. We dealt with that. Even in our workforce housing projects, we have probably, I think, close to 2,500 units in LA County. And, we dealt with a lot of bad debt issues. There were a lot of bad actors on the tenant side that those stories haven't really gotten out, but I could give you a litany of those stories.
Well, when they have a G-Wagon, right, and they're not paying rent for
one of my
it's
not favorite, it's not the right word, but one of the stories I had is we have a property in Glendale. It's a workforce housing project. We had a tenant show up to the management office, say, hey, can you watch my unit? I'm going to Hawaii for 2 weeks. The manager said, you owe $50,000 in back rent. She said, well, I don't have to pay that, right? And so, I have a litany of stories about that, of people taking advantage of it. And so, unfortunately, when you are an institutional landlord, consistency of NOI is really key. Pre-COVID, LA County had the lowest amount of bad debt in the country. During COVID, it had the highest. So it switched. And so I think institutional capital was specifically attracted to markets in Southern California because it's hard to develop. They've had strong demand and there's stability, right? The other thing we have Prop 13 protection.
Yeah.
So we have massive stability in property taxes. Starting to invest in Texas, I will tell you, that's a huge benefit in California. So all those things lent California to be this institutional market that everybody really liked. But all that regulatory change, you're even seeing it today. LA County put an eviction moratorium related to the fires.
Yeah.
All of that has really turned off the institutional ownership group. I will be honest with you. I think there's no better market to invest in the United States than LA County right now for the very reasons that I think, when people are selling, you might want to think about buying. And I think that people they're focused so much on the negative that they don't realize that there is very little supply that's going to get built.
Oh, yeah.
14,000 residential units just burned down in LA. Our portfolio in LA County is about little over 98% leased.
Yeah.
And with not a lot of new supply on the horizon. So, and I think the regulatory environment is going to get better. I'm optimistic there. And I think that my sense would be we're at sort of that inflection point. But there is a lot of investors who want nothing to do with California.
Okay, so you mentioned that you think right now LA County is one of the best places to invest.
Correct.
What are you investing in? What would you invest in?
I think, I saw a deal. It's probably the best deal I've seen in a while. Gary Leshold bought a deal in Hollywood, brand new Class A project. Well, it was built, I think it was delivered 2021.
Yeah.
For I think $338,000 a unit.
Yeah.
Right?
Was that the View?
Yeah.
Yeah.
The replacement costs on that, $550.
Yeah.
Right.
Yeah.
And when you look at that basis, right, and you think about, the fact that when you look historically, like I actually talked to him about this. I said that was a phenomenal buy. And I joked with him. I said something to the effect of like, I never invest with other people, but like I would have invested in that deal, right? Because it's just, at a basis like that, you can't go wrong. And look, does Los Angeles have its challenges? For sure. Obviously, it's been massive, right? However, I look at us on this day and it's beautiful and there's still a lot of strong demand drivers here. And my sense would be, things will change, right? Things are not static. And when you look at that basis, I go, I don't know where you can get such a discount to replacement cost.
Yeah.
Where what you're really doing is you're impeding any new supply. Because why would a developer build in Hollywood when they can buy for that cheap?
Yeah.
So it's this self-fulfilling prophecy that I look at. There's also been some buys in downtown LA, FPAs made, where you look at it, you go, you're blocking anyone from building new supply based on this comp. So you're protecting yourself. Sort of the exact opposite of what I saw a lot of syndicators doing, and I've been very, vocal about this on LinkedIn, in markets like Phoenix and Vegas, where you saw them paying $250,000 a door in 2021 and 2, and you're going replacement costs like 275. You're inviting competition.
Yeah.
You're going to be your own worst enemy
Yeah.
by continuing to pay these higher prices. The opposite, I think, is true in LA, and so it's going to put a huge, dash on new development. And we just lost 14,000 residential units, right? Tragically.
Yeah.
And I can tell you that is, our demand has gone through the roof because of that. And we're the largest, I think we have the largest amount of units in the city of Pasadena, workforce housing units. We're 100% leased we're about 1,500 units there, right? And so, it's extremely sad with the fires. The corollary is, you're in a market that was already supply constrained, and you just took 14,000 residential units, whether they're homes, apartments, whatnot, condos, off the market. And so, in my opinion, the juice is worth the squeeze in LA. Even though I know it looks really dire right now, and it looks really tough, and there's a lot of landlords who are really upset about this latest eviction moratorium, which I can understand. My sense would be, when you study the other markets around the country, I think this is a great place to look at if you have the ability to think 5 to 10 years.
Long term, because I was just having a conversation this morning with another broker, and he was talking about his best year that he'd ever done. And it was in 2022. And basically he was telling me, he's like, we could sell anything. We put it on the market, it would sell. Right now, we have deals personally listed and from other conversations with brokers that it is almost anemic, the amount of activity that we're getting. And these are 6.5, 7 cap deals that genuinely we're hearing crickets on. And so it's interesting to me when I talk to you and you're like, this is a great opportunity. However, a lot of these small time syndicators or these guys doing these, 6 to 50 unit buildings, they're like, I don't know, I need it for 25 bips less. What's going on? Why do you think there's a disconnect between the institutional and to lead and follow into that is, you said a 4 cap in Orange County, right? Why would someone buy a 4 cap in Orange County when they can get a 5.5, 6 cap in Los Angeles?
It's the regulatory risk. So I think, when you look at Irvine, you have no risk in Orange County. You don't feel you're going to get any risk with bad debt. You don't feel you're going to get any risk with eviction moratoriums.
But are they underwriting? Because you're getting a 4%, they're buying all cash, 4% yield. Are they anticipating rents growing up?
I think when you look at a market like Irvine, you would say they feel like there's going to be stronger rent growth there. You've got the Irvine company who dominates that market so much that it's actually really hard to buy Class A product in a city like Irvine. There's not as much opportunity.
Got it.
And so I think they view that as core a real estate as possible. And by the way, if you saw this project, I would strongly argue it is core multifamily.
Got it.
And so my sense would be that's a set it and forget it, right? You're going to be 95+% leased. Irvine has, I don't think, ever dipped below that in a long time. The Irvine company controls so much of that supply. So it's a unique submarket, right? And I think they're willing to do that. I think in LA, it's the regulatory risk side, right? People were so scarred from the COVID eviction moratoriums and having such hard, the relationship between your tenant and yourself in LA County, it's just different. It's hard. And when you're a landlord, when you're an institutional landlord, you're a private landlord, that's not a fun place to be in sometimes.
No.
And it's really hard. Now, you and I talked about the fact I teach at USC, and what I always tell my students, just because something's hard, sometimes you want to lean into hard because that's where opportunity can be when other people don't want to. But it is very hard to be a landlord in LA County. It's extremely hard to be a landlord in the city of LA. If you think about this eviction moratorium related to the fires, effectively what the county is doing is saying if somebody was impacted by the fires, landlords, you have to subsidize them potentially. Now, there's ways in which they say if you apply, you have to apply for assistance, and there's assistance out there, but they're really putting the onus on landlords, which is completely unfair, right? And so people just are sick of that, right? And they're sick of how hard the last 5 years it's been since COVID started, which literally, by the way, it started like 5 years ago, which is crazy, right?
Crazy.
But it's been really hard to be a landlord, and people are sick of that. And when you go to markets like Dallas or, some of these other markets where there's a lot of job growth, there's a lot of population growth, and you're not worried about any regulatory risk, right? And so,
is that something that you teach your students at SC? Because what class do you teach at SC?
Yeah, so I've taught a bunch of different classes in the Masters in Real Estate Development program.
The MRED.
The MRED, yeah.
Very well known for.
Yeah, and I graduated from the program in 2009. The last 3 years, I've taught a real estate entrepreneurship class.
Okay.
So it's basically a class to graduate level students who have some level of real estate experience, who are in the MRED, and my goal is to teach them about, okay, you want to be an entrepreneur. What does that mean? How do you raise capital? How do you put a business plan together? How do you put a business plan together on a deal? What type of structure should you look for? How do you recognize opportunities? How do you underwrite projects? How do you do I do a lot of back of the napkin underwriting, right? And really it's about all the things you need. And it's,
like
obviously
getting your first deal.
It's like getting your first deal, right?
Yeah.
And how you would capitalize and how you should think about it. And I bring in a decent amount of guest speakers too, entrepreneurs, people from the capital side, to really talk about, what it takes to start a company and to raise your capital and to put a business plan together and do all those things. So that's the class I've taught for the last, this summer will be my, I think third or fourth time teaching that class.
What have you learned from being a teacher?
It's a great question. What I always say is I think I learned just as much as the students, because I remember a student once asked me this question saying, Professor, you mentioned a double promote. Like, can you explain what a double promote is? And in my head, I knew what it was, but I couldn't articulate it. And I tried and I did a bunch of word salad. It was like it just wasn't coming across well. And so I was like, okay, from my standpoint, I think I have to go back, and I researched it. And I came back and go, this is exactly what a double promote is.
Yeah.
And so I remember I was like, I taught myself how to articulate them. And the students at SC are really smart. And so if I say things, they'll challenge me, they'll push me. And so I've learned probably more about real estate, because you have to articulating something and not just having it in your head.
Yeah, it's teaching it. You learn it better.
Is teaching it for two. Two, I have a tremendous amount of respect for teachers. When you're teaching, you're somewhat on stage.
Yeah.
And to put a lesson plan together, I think about some of my teachers that, and coaches I had growing up. I go, wow, it's a lot of work. So I have a tremendous amount more respect for teachers. So I've learned that for sure. And I've also just learned that, you hear a lot about the millennial generation. You hear there's just all this talk. Then you're in front of these students and they're awesome, right? And they want to learn, and they're so interested in real estate, and they really just want to grow their careers. And so I get a lot of energy from them.
Yeah.
And so it's been an awesome experience for me to be a teacher. And I teach in the summers, and I really look forward to it now. It's a lot easier now that I have the lessons plans set out too, so I know what I'm going to teach. That was hard the first couple of years, but I really look forward to it. And it's really the students' energies, because I think that, there's a lot of people that are, younger, that, want to be successful, that want to be in real estate. I think this is a great business. And so when you're around that type of energy, it's just infectious.
I have a lot of young people come and ask me about brokerage and hey, should I be a broker? All that kind of stuff. Because I've had enough success in the beginning where they've seen, okay, this is what it could look like potentially. You were a broker.
I was.
And you are in front of these students. If they come to you and say, hey, what should I do to get into real estate? Should I be a broker? Should I go work at a big firm? Should I be an analyst? Should I go and work at a development shop? What advice personally do you feel, and not from like this, but I guess how would you approach that question?
It's a great question. I had a mentor of mine, I met through my dad, who was a self-storage developer, who, when I was thinking of getting into real estate right after college, he broke it down really succinctly to me. And he said, there's like five areas where you can get started in real estate.
Mm-hmm.
You can't really start as a developer
because
when you think about development, it encompasses so many things.
Yeah.
For instance, we were talking about this project, right? If you think about how we put this deal together, it encompassed a whole host of different skill sets that we needed to be able to put together. And so his point was there's ways to get started. So one was brokerage, right? You can do investment sales brokers or leasing brokerage. It's where a lot of people start their careers in real estate. Brokerage firms are always looking for sort of young and hungry people to come in, either cold call, do analyst work, do grunt work. There's always a need for that. So you can start in brokerage. You can start being a financial analyst. So you can go to work for a bank, you can go to work for an equity fund, you can go work for a brokerage firm and just crunch numbers all day long and learn the numbers, right? You can go do that route. You can go to law school and you can become a real estate attorney. And, real estate law and real estate's all about contracts, written contracts. There's a lot of legal aspects of real estate. So you can go that route. You can go the construction route, right? So you can go be an on-strike construction person and go work. I mean, obviously you were probably driving through downtown Long Beach. You saw a couple of projects on construction. You can go be a superintendent for a contractor and learn the construction business. Could be a big part of real estate. And then really his last point was you could go be on the property management side, right? So you can go work in property management. That's a very important skill for real estate, understanding how properties actually run from a P&L perspective. And those are really, and each one of those areas, generally speaking, will hire young people, right? Now, being an attorney, the one challenge with that is, you got to go to law school. So that's probably the longest.
Yeah.
But all those positions will generally hire what I would call as associates, right? People without experience that they can go train. So what he said is within those, his belief that the two best areas for the fastest career success was either financial analyst or brokerage.
I would agree.
And so, but then it comes down to your personality, where you think you could be successful.
Yeah.
And he's like, do you like sitting in front of a computer, John? Or do you like talking to people? I'm like, I like really talking to people. I like being around people.
Yeah.
He's like, the challenge when you're a financial analyst, you can sit in front of a computer screen all day long. So his advice to me was he thought brokerage would be the best. Then you go into, should you do investment sales brokerage or should you do leasing brokerage? I chose leasing brokerage. More so that was the job that was offered to me at the time. And I had to get my foot in the door.
You're doing leasing.
And so, there's a lot of pluses and minuses about those different brokerage types.
Would you do debt?
So what's interesting is debt and equity brokerage, which when I got into the business back in like 2003, 2004, was not as prevalent, right? That is a much more prevalent brokerage business to be in. I have said this on LinkedIn. I would tell you, I think being a debt or equity broker from investment sales, debt or equity or leasing, I think debt and equity would be what I would tell somebody to go into.
Same.
And because I think what's interesting, unique about it is you're going to learn, when you learn debt, you really are learning real estate too, because it's a component you have to understand.
You have to underwrite the deal.
You have to underwrite the deal.
Know where the money's coming. Really, and sorry to interrupt.
Yeah, no.
I'm passionate about this too, because I'm so far deep in the investment sales world of multifamily, but I've recognized through the debt process of there's so much that goes on besides just, I'm a conduit, right? I'm getting a buyer and a seller and putting them together. Debt is actually, and equity is really making the deal happen.
100%.
And I've had so many clients of mine say, hey, you have any LPs for like, we just got this deal locked up, we're trying to raise money. I mean, if I had LPs, I think I would have unlimited money because there's so much need for that kind of service skill. And then on the debt side of things, for what we do in the investment sales, if you're lucky, right, you work with some syndicators or some value add guys, and they'll buy it, they'll renovate it, and sell it with you in a couple of years. But most people, most sales, and the people who pay the highest where I do business, which is Los Angeles, is typically these mom and pops buy one deal every 7 years, and they're not selling. It's going in the back pocket in the portfolio for the grandkids. And so I don't have that natural recurring revenue where when you're doing debt or equity, you got to refinance that's coming up. You got to either sell it or do something else. And if you bring the equity in it, you bring the debt, you have your investment sales team work on it. There's so many ancillary and value add that debt brokers bring.
1,000%. The other thing, so that's what always intrigued me about leasing. So when you do, let's say, office, industrial, retail leasing,
it's an easier
usually doing 5 to 10 year leases. And so what you know is if you're in that business long term, you almost call it annuities, where it's like, hey, you put a client in space for 5 years. After 4 years, you call them and say, it's time to renew. There's going to be a transaction that takes place. And you know instinctively, like, there's a transaction taking place.
Yes.
And so you can be, I remember, cold calling tenants a little bit more bold, like, you got to figure something out. Like, your lease is coming up, and by the way, like, the landlord pays our fees.
Yeah.
So, like, why wouldn't you be represented? Why? It makes no sense not to be. But instinctively, like, even in a bad office market, which we're in right now, let's say vacancies go to, 20% in a submarket, still 80% of the buildings are full. You figure everyone's signing 5-year leases, like, there's still transactions taking place, right? And so that's what always intrigued me about leasing. Where debt brokerage, specifically on multifamily, let's take it, I've just been always more intrigued with and always thought that was a great avenue to enter, is let's say you do agency debt. Well, if I want to get agency debt as an LP, I have to go to a Walker and Dunlop, a Berkadia, a CBRE, because you can't go direct to those groups. So actually, like, it's almost better because you're like, you need me. And so that conversation is different. And so I felt like if you can be in debt and equity brokerage, as that business has really evolved, and it was so niche when I started, now it's really become a much more full-fledged business, specifically in multifamily.
Yeah.
Understanding how debt works, understanding how equity works, huge, right? Because for you, if you had those LPs, I'd probably tell you, well, what do you need your syndicators for? You go do it, right? And so I think to learn that space, my opinion, that's where I would advise somebody coming out of school. I think that's an awesome space to be in, because you're gonna learn a lot, and you can take, I just feel like there's a lot more transferable skills. And even in a tougher market like this, like, people are still refinancing. People are still doing things. And so from an income standpoint, I think you can build a little bit more durable income, and you can learn more specific knowledge that I think could benefit you long term.
As someone who transitioned from the brokerage to the principal side, you probably get a lot of cold calls.
You know what's funny? I don't at all.
Really?
I get, the irony is, I get some.
Is it because you've eclipsed the mom and pop where people, and look, I'm, as humbly as possible, like, you're a big dog, right? You own thousands of units where a young guy who's historically going to be cold calling.
By the way, I'm going to say this, I'm going to get 1,000 calls after. No, but you know what? I get some, like, it's not that I get zero.
I definitely called you.
But I get, for sure. I think you probably have. I get some. It's probably harder to reach me now because, like, my office line at work. I joke, like, nobody calls office lines anymore, right? So, like, if you call me, and I don't really publish my cell phone that much, so it's a little bit harder to get a hold of me. But I don't get. I mean, I get a lot of emails about 7-Eleven's trading in Tuscaloosa, Alabama if I want to buy it, which I'm always like, how do these people know me on these lists? But I don't get as many cold calls as you would think. The real irony is I get nobody stopping at my office, right? And so, like, when I started in brokerage, I was doing office leasing and some industrial leasing. And the way we call it, walking buildings, right? So traditionally, cold calling in leasing brokerage, specifically office industrial, is sometimes you do it on the phone. A lot of times you just go, I'm literally staring at an office building right behind us in downtown Long Beach. Like, you would go and we call it knock on doors, and you would go in with your card and say, hey, who's the decision maker? I want to talk to that person. I want to see who represents you. And so you do a lot of cold calls. Because the other thing is, when you cold call an office building, like, when I started in the business at Grubb & Ellis, this was 2004. And end of 2003, beginning of 2004. And the mortgage, the subprime mortgage, boom, was going on. So there are all these subprime mortgage companies. So you'd walk a space and you would see like 20 people in a 2,000 square foot office, and you'd be like, you guys are in way too much space. So you see that, right? Like, you notice it,
you understand,
and then you're like, okay, you need to expand, right? And so it's really helpful. And so that's how I started, right?
And people are not doing that now.
No. And so the other thing is, like, I would cold call real estate companies, be like, hi, I'm John with Grubb & Ellis. Like, I know you probably don't need somebody to represent you, but, like, is the owner here, right? Yeah. And it'd be like a development firm. And I want to learn about how you do development. And I remember, like, people love that, like, somebody showing up. I don't think I've had somebody cold call me like physically,
Yeah.
maybe once since we started. And I'm always like, and the irony is there was a guy who's now at, is he at Bercadia or is he at CBRE? And I helped him get an internship, and I still see the guy with the Bascom group. I helped him get an internship there, and he's always thankful about it. I'm like, well, you showed up at my office,
right,
Thomas. And I'm like, my standpoint would be, I never get that. And I've never, like, if somebody showed up at my office to be like, hey, I want to talk to you, John, about real estate or deals, I might be in the middle of something, but I know for myself, I'd be like, talk to my assistant. Let's get a time. I appreciate you showing up here, using that foresight. I'm happy to sit down with you.
Interesting.
Phone calls and stuff like that. What's hard is like I get so many email, all that stuff. It can get drowned out.
Yeah.
But even so, like I don't get as many cold calls.
So like, okay, the really good broker's got a really good deal. I got a really great off market deal, John. How do I get a hold of you where you need to see this deal? If you have 1,000 emails in your inbox, the phone, I don't have your cell phone number. Like, how do I make sure that you see a deal that I think you want to buy?
So there'd be two ways to do it. One, you'd put a great subject line in an email to make sure it goes through. And two, you'd call me. Then you'd hit 0. Probably goes to my assistant, and you'd go, I've got something I really want to talk to John about.
Yeah.
Because she's a quote unquote my gatekeeper.
Totally.
And, she'll say, okay, no problem. What is it? She'll take a note down and she'll hand it to me. Right. And so I think it's that if you feel like you have a good opportunity, you feel like you want to get in front of somebody, this is all going back, by the way, you're bringing up all this stuff from my Grubb & Ellis University days. For those who are listening, Grubb & Ellis was a big real estate company I worked for that went bankrupt. But we used to do this Grubb & Ellis University, and they used to bring in there's a guy by the name of Dave Hibbard. Dave Hibbard was a sales trainer. He was a former manager at Grubb. He did sales training.
I love that.
He was classic. For anybody who's listening, whoever took sales training from Dave Hibbard, I'm wearing long socks today. That was Dave's big thing. He used to bring people on stage, say, show me your socks. If you had short socks on, he's like, you can't ever have short socks. Somebody could see that. You always want long socks. So I still to this day wear long
Me too.
socks.
I have them on right now.
Yeah, that's right. Yeah. And so Dave would do live cold calling. Right. And he had his office in the Irvine Spectrum, and he would do a live cold calling with you. It was really intense. And he'd be calling tenants, right? Most of the time office tenants. And his whole thing was like, how do you got to get something in front of the decision. So like, don't just, his big thing was you can call the person direct. And if you got to voicemail, 0. Who's this assistant? I need to talk to him. Here's this, put a note on his desk. It's really important. And so that was his big shtick, right? Wow. And he thought, get the note on the desk, and then he would go show up at the person's office.
Got it.
He was one of those people like, don't accept no for an answer and figure out a way to get in front of that person. And if you're persistent, you'll do it. I think it's gotten to a point where that kind of old school style, if I was giving broker advice, I would be like, yeah, you can go make 50 calls to people, send 50 emails. If you spent the time to research where somebody's office is and you showed up to 10 people's offices, I would think you'd have way more success. And if you're persistent that way, because what I saw from cold calling is it's really easy to hang up on somebody. It's really easy not to answer an email. It's really easy not to answer a phone call. When somebody's in your office, like it's really hard to be addicted to that person, right? Because you're taught, right? You're
100%.
You're talking to them and you're like, okay, that's, if you call me, it's like, oh, whatever, right?
Yeah.
Go to voicemail.
Exactly.
Technologies work that way. If you're in my office, you're dressed well, you present yourself well, you're like, John, I'd love just 5 minutes of your time. It's really hard to me be like, man, you came all the way to my office and you just want 5 minutes.
Yeah.
Maybe some people, look, everyone's different. I'm more the person who'd be like, yeah, of course. Hey, why don't you come down tomorrow? Why don't you, let me help you and let me see what you have.
Yeah.
Let me spend some time.
Tell me a little bit about the transition when you switched from going from the brokerage to now going on the principal side. And what did that look like? When was this the first deal that you did, or what? Give me
no.
Give me the timeline.
No. So when I was in brokerage, I had a really bad experience with a client where we got totally screwed, which every broker deals with.
Yeah.
Totally screwed on a deal where we were representing it was an office tenant They wanted to buy an office condo, which was all the rage
Mm-hmm.
in Orange County at the time. This was like 06. And we showed them one. We had represented a buyer of another small condo next door, so we knew the comp. Like, we had done all this work. And literally it was the case of like this client, like wife's best friend's husband was a broker and was like, oh, that price is too high. I'll represent you. I'll get you a better deal, even though we had represented the building next door. And so the client goes dark, and the developer of this office condo calls me. He goes, hey, John, like this group just submitted through a new broker. You'd already submitted, like, I don't know what to do. And I was like furious. And he's like, look, I'm going to agree to a deal. It's the same deal I gave to you, but like they're saying this group represents them. I'm sorry. And I remember I was so upset by it, and went and showed up, I had a partner on the time who showed up at the guy's office. By the way, this is old school.
Yeah.
Showed up at the guy's office because he wouldn't return our phone calls. Showed up at his office and kind of barged into his office. I remember this. I think I was like 26, full of piss and vinegar.
Yeah.
And we showed up at this guy's office. What was it? CSC Engineering. I still remember it.
Oh my gosh.
Or SES Engineering. Showed up at the guy's office, and we were like, what'd you do? And he was like, look, you guys are young guys. Like, this guy's more experienced. I'm like, you got the same price we agreed to. We represented the group next door. And I remember the guy that I was working with at the time just sort of, that's just welcome to brokerage. And my partner on that deal. And I was really fucking pissed off.
Yeah.
And that's when I was like, I don't know if I have what it takes to be a broker, because when you're on the principal side, like, I don't think somebody can screw you like that. I don't know. I was good at finding stuff, and I was good at it. And I did really well. And, but that's when I was like, my eyes got opened up. Like, I'd really like to be on the principal side.
Yeah.
Because the developer in this case, he didn't get screwed.
Yeah.
He sold the price, right? And I was like, he didn't get screwed, and he had all the control, right?
Someone else's destiny.
Someone else's destiny. And so around that time, I had heard about the MRED program at USC. I started doing research on that. I started talking to people. I was always big, especially in my 20s and 30s. I still am. I love talking to people, but I was really big on information interviews and trying to get in front of people. And I asked them about this program. They said, that might be a great program for you. And so I made the difficult decision to go back to grad school. I was doing well at Grubb & Ellis, but I made the decision to go back to grad school at USC because I thought that would be a great pivot point. And that's where I think graduate school, when I tell people, they ask me, should I go back to graduate school or not? I go, if you're looking to make a pivot, if you're like, I'm doing this, I want to keep doing this. I'm like, I don't know if graduate school is the right for you.
Mm-hmm.
To me, it's when I'm a broker, I want to move to the principal side. I leverage the USC program to go do that. And it kind of puts some space into, because a lot of people I would talk to is like, oh, you're a leasing broker. As my mom called me, a leasing realtor. And so, a rental agent.
Yeah.
That it gave me some space. That's why I made the decision to go back to school. Now, I went back to school fall of 2007. Literally the world. I started in the MBA program because I did the MBA program at SC. I started on a Monday. If you go back and look, the credit markets, it was like August 12th.
Mm-hmm.
There's a Friday when the credit markets on debt for subprime mortgages froze.
Yeah.
Like literally there's like, you can go back and look at this. I started grad school on Monday, following Monday. So the world kind of fell apart, right? And so, but that was the transition that I needed. That was the pivot point I needed to go to the principal side. And through that program, I got connected to a man by the name of Wilbur Smith, who runs a company called Greenlaw Partners. They're an owner-operator of mostly industrial and office assets in Orange County. When I got out of school, it took me about 7 months to find a job, but finally I landed a job with him as an acquisitions and asset management specialist. And this was end of 2009, beginning of 2010, and we were buying mostly distressed office and distressed, by the way, if you can believe this or not, distressed industrial.
Wow.
Throughout California and Arizona.
Okay.
And so I joined them at the end of 2010 end of 2009. And that was my foray to moving to the principal side of the world. And that's when I really learned I leveraged my leasing skills to do, value add office where you have to do a heavy amount of asset management, but I learned all about raising capital and debt, how equity partners look at projects, how you oversee property management and leasing brokers, how you execute business plans, And so I was there almost 5 years. And my challenge was, I always tell people this, I was never I never won any coaches award. I think I'm a kind of a shitty employee because I was always the type where like, I think I know better.
Yeah.
And having been a broker, having been an independent contractor, once you get used to it, you're running your own P&L, right?
Yeah.
And I think that's one of the best, by the way, that's another great part about brokerage is you're really running your own small business.
It's a business.
I remember going to my manager at Grub 2 years in, like, hey, I'm going to go on vacation for a week. He's like, okay. He's like, I'm like, do you need to sign something? He goes, no, you're an independent contractor. Like, I just care what you're like. Are you covering your desk costs?
Yeah.
When I worked for him, where I struggled was I'm just not a great employee. And, there would be projects where I'd be like, I don't think that deal works. He's like, well, I want you to underwrite it. And you realize, as my dad would say, if someone's signing a check for your salary, you do what they say.
Yeah.
And so it was probably 3 years in when I realized like I want to do my own thing. And I eventually left in August 1st of 2014.
Okay.
And my goal was to do value add office and industrial
because
acquisitions. That's what I know. That's what I was going to do. And that's where I had built specific knowledge. I had built some core skill sets. And I felt like as I tell my students, I felt like you would invest money with me, even if I was newer in a value add office, because I could articulate the business plan. I could show you, I had the relationships to execute. I had the expertise, right, to execute. And I had the knowledge base to really execute and experience, right? So I had the kind of the core skill sets where you go, John, you know what you're talking about. You've been doing this a while. So at that time, though, I've told this story multiple times. I had known my now business partner, Sean Rawson. We had met through a young professionals real estate group that NAOP put together about 4 or 5 years before then. He was a affordable housing and market rate housing development specialist. That's what he had done throughout his career. He had sold land. He had done market research for residential projects. He had worked for a developer. He had gone off on his own about a year before me and was doing affordable housing development and market rate development and entitlement projects throughout California. And we had talked over the years about potentially working together and finding an office building that had excess land that we could build a parking structure on and title the excess land and surface parking for multifamily. Him and I always just got along really well. We're both very entrepreneurial, different, but entrepreneurial. And we went to lunch and I was telling him what I was doing. And I was like, hey, I'd found this office space. I need somebody to share it with me. I had gone down the road where I was maybe going to partner with somebody when I left Greenlaw, but that it ended up not working out. And I said, I need somebody to share office space with me. Like, what are you doing for office space? And he said he was in his executive suite. I'm like, I think this would be cheaper if we shared space. So we went after lunch. We looked at the space. He called me the next day. He said, yeah, let's share office. So we signed a 1-year lease on an 850 square foot office space.
Wow.
And in that space, basically, we realized that let's start talking about deals. And that's kind of how it came together. And so this leads me to, it's long-winded, I know.
Yeah.
But it leads me into how I got into multifamily.
Yeah.
So about 6 months into us sharing office space, I was doing acquisitions. I had acquired a couple office buildings. Sean was doing his projects. We were out to lunch. And I asked him the question. I said, and a lot of times great ideas come from just asking questions. What would you be doing if you weren't doing affordable housing development and, these market rate housing entitlement projects, land development projects? He's like, I've always thought, and I worked on a business plan in school to buy sub-institutional multifamily in supply-constrained markets where new supply is really driving rents, and you have this older product, specifically in Southern California. We have all this 50s, 60s, and 70s product that was built that you could draft off of that. And if you could go buy a deal, really improve it, that there was a great business plan around that. And specifically, I've been in Long Beach now about 5 years. I've been living here. I see all these older apartment buildings that I feel like there's a ton of value add potential with. And Long Beach is changing, and it's really improved after the GFC. I said, what's stopping you from doing that? He's like, I don't have the capital partners. That's a different capital source. I don't know. I go, I've got a bunch of capital relationships that I've developed over the years. I think would be highly interested in this. It's like, well, let's look at it. I go, so let's go look at it. And so I always joke is we met with a couple of them. They all said the same thing. It sounds interesting. Show me a deal. And then 3 weeks later, Sean called me, goes, hey, we got a deal tied up. I go, what? What do you mean we have a deal tied up? He goes, well, I had to tie up this deal. he had found it through, Sean's a great hustler,
Yeah.
through a relationship to a broker, got connected to a 14-unit deal, literally probably about a mile from here.
Wow.
And we had to raise about $1.2 million of capital. And I went to the people that we had met with, and the bulk of it came from 4 people. And we did some friends and family too, and we raised the capital, and we bought a 14-unit value-add apartment project.
How many days of DD did you have?
We had 30, and we had to go hard on a deposit. And then we had 15. We got 15 days to close, and we eventually negotiated another 15.
Okay.
We closed with debt.
So you had 30 days DD and then another 30 days to close. So 60 days total.
Correct.
And so you had to raise all the money.
The irony was when Sean called me, the clock had already started. Because the one thing I learned from multifamily is when you do these car contracts, in multifamily, it's like buying a house where you go under contract when you make an offer.
Yes.
Which when I was buying office buildings, you were negotiating, you were doing all this stuff. I was like, what? We got to put, and so we had to put up, I think we had to put up $100,000 deposit, Sean and I. So we did it. Now, it wasn't hard, but it was like, I was like,
that's leaving my bank account.
Yeah. And so we went and toured it. And Sean had done the math in his head, and I agreed with him. And the whole deal came down to, could we get these much higher rents at the project that we thought once we remodeled it? And so it was mass chaos.
Gee.
I mean, we're building investment model, like it was chaos. But we felt there were a lot of merits to the deal. And we felt very strongly, we articulated a great vision of how we could hit these rents.
Yeah.
And so, but it was mass chaos. And then we had to go hard on a deposit, but we had raised the capital.
And then that
most of it
deal led to, I assume that deal worked out. And you said, we can do this.
So what ended it, so the story I told before, so we buy it and our investors are like, can you get these rents? We're like, yes. And I literally remember walking out of the meeting with Sean. I'm like, we can get these rents, right? He's like, yeah, I think so. I'm like, okay, we're going to try, right? And we bought the deal. We had a vacant unit. We had found a construction firm. Like, we put all this stuff together like quick, and just hustled. And we found this contractor through a referral who ended up being a contractor we did a bunch of business with and was awesome.
Wow.
And we found them. They looked at the project and they told us how much a unit would cost to rebuild. And we had a renovation budget. So we renovated a unit, right? We were going to redo like all the common areas and all this stuff. And my point was like, let's renovate a unit and let's see. So we had underwritten $1,450 in rents for a 1-bedroom apartment. The existing rents in place were about $1,000.
Okay.
It was a pretty big jump.
Yeah.
So we renovated this unit, and we did everything we thought we were going to do, and it turned out really well. And we finished it on a Thursday, and the management team we had hired listed it. Said, let's see how the activity is this weekend. Sean called me on a Sunday. I'll never forget this. And he says, dude, we got $1,595 for the unit. I go, what? I go, I thought we were listing at $1,495. He goes, no, I switched at the last minute. Let's go $1,595. And if we have to offer concessions, let's see. He goes, literally, person toured it. We just signed a lease at $1,595. I was like, oh, wow, that's awesome, right? So, put together an email, call our investors, like we got way above what we thought. And they were excited. And literally the seller, a group owned 2 20-unit buildings across the street. That same week, a broker called us, said, hey, I know you just bought this deal. Would you be interested in the 2 20 units across the street? We're like, yeah, like we think we can get these rents. We'll pay the same per door. Sure. And we ended up we went to our partners and we said, look, we can get these rents, right? And they believed us. I think, we had one lease. So we ended up buying 40 units across the street. And then it kind of away it went. And that was my foray into multifamily.
Wow.
So what I tell people is, if you make a transition, one of the easiest things to do is we started really small, right?
Yeah.
I tell all my students this. I tell them, you can raise $1 million of equity. You would be shocked. I go, in this classroom, you would probably think, where would you go? Ask the people raise your hand in this classroom. How would I get $1 million? I guarantee you, somebody's dad, somebody's uncle, somebody in this class, somebody knows somebody, you can do that. And so, we started really small on the multifamily side, which actually ended up being awesome because we cut our teeth on smaller deals, really learned a lot about rehabs, construction, how markets work.
Let me ask you something. How do you ask for money from someone? Because that to me, I'm not scared at all about cold calling anyone. I'll go into anyone's office. I'm a glutton for just people saying no to me. I love it. I'm a masochistic. But asking people for money feels like it's like this internal, like I need a handout. I need something. And I know it's not. But what is the structure or the way that you would tell someone, hey, you have a deal. Here's how you go actually get the money.
So here's what's funny. I would tell you where I struggled the most in brokerage was cold calling because it was like, and this was, I think office leasing, industrial leasing is a little different because it's like if somebody has 4 years, you don't know, like at least in when you're doing investment sales, like nowadays too, especially like you can look up on CoStar, like when do they buy it? What do they pay? Stuff. A lot of times you're like, I don't know if they literally just signed a 5-year renewal. So like this person's dealing with stuff. They're also like their office lease is not that important. So you get rejected a lot and you kind of feel like a schlub a lot of times. I've found raising money a lot easier. Now, first thing is, do you have a good project? Do you have a project that makes sense? If you have a project that makes sense, like the deal I talked to you about in Hollywood, right? If I had that deal tied up, I would call people. I'd be like, just give me your bank account. Like you're going to put money into this. Just don't ask questions. Because for me, when you have a good project, people with money want to make more money. So if you're not really selling them something. Like people like talking about deals. I found it's a much easier conversation. Do you want to put money into something? Yeah, I'm always interested, especially people with money. They're always interested in looking at opportunities. So then it's about being able to evaluate stuff and finding the right opportunities and having confidence that you can execute. So I think where, you should think about if you're struggling in that, it might be more the struggle for yourself of, I know deals, but like, do I know value add? Do I know I can execute a value add strategy? If I'm buying a 14-unit deal, do I feel confident enough being able to execute? When we raised money for that 14-unit deal, you got to keep in mind, I had raised money and been a part of a lot of value add commercial transactions, much more complex, much more, we're remodeling lobbies, we're redoing bathrooms, we're doing big TI projects. I mean, I had worked on a 100,000 square foot, 20-year lease with the FBI where we had to build them a parking structure. I had to build them a skiff space that is, which I could go into. And like, I had to build them basically like a space that had this fence around it, outside the parking structure, outside the building that a Mack truck could drive through and couldn't hit it. So very complicated type stuff. So for me, I'm like remodeling apartments, not that hard. And so I had a lot of confidence in that. My sense with you is where you might be struggling is you might not have the confidence to go, I don't know what I'm doing. And when you're in brokerage, the nice part is somebody buys it, you step away. You don't have to worry about it anymore. When you're on the operating partner side, like you're in it. Something goes wrong, you're in it. Tenants stop paying your rent, you're in it. And that is a level that, and I'm not trying to get into you personally, but you might not feel as comfortable with. So then you ask yourself, maybe that's blocking that, right? Because you're going, like when you raise money from somebody, it's a sacred trust. Probably one of the reasons I'm so vocal on LinkedIn for the people who have really, I think, were acted really inappropriate this last cycle on the syndication side and raising capital from mom and pop people to do deals. They're like, you knew that was a bad deal and you just collected fees because it's sacred. Like you take somebody's money and you tell them I'm going to invest it. Like I feel, much like that money's my money. Don't want to lose it. I have an attitude of like, don't lose their money, figure out a way out of it, treat their money like it's even more important than yours. So there's a lot of that goes into it. So you have to have a lot of confidence. And you have to have a lot of ability to think to yourself, like, can I do this, right? Do I feel comfortable taking somebody's money? Because like once you do, it's not like brokerage where it's like, oh, building didn't work out. I'm sorry, not my problem. This is, okay, you're in it, right? And there's a lot of difficult conversations that can come of that. And it's just, it's a lot.
Do you think the best way to build wealth in real estate is through the ownership side of it? Or do you think that if a person's made to be a broker, that they can do the brokerage side because obviously there's less risk associated, like to get wealthy?
To get wealthy
in real estate.
Yes.
What do you think the best path forward?
Being an operating partner. It's to me, being a joint venture operating partner, the way to create wealth, in my opinion, what I tell my students is you have to figure out a way to take $1 and turn it into $10, right? And then you have to take $10, turn it into 100, you take 100, and you have to turn it right into 1,000. So that's the way to create wealth. The other way to create wealth is sustainable income streams, right?
Mm-hmm.
And so the challenge with brokerage is, it's not a sustainable income stream. You're only as good as your last deal. So you have to always be hustling. If you think about, let's take this project, right? We get asset management fees from this deal. Yeah, we got an acquisition fee when we closed. We get ongoing asset management fees and some other fees related to this deal, right? I can hire people from my team. I've got great people on our team I'm really fortunate to work with who can do a lion's share of the work, right? So I can outsource it, right? But I'm the owner of the company with my co-founder, Sean. So, but we're getting paid, right, to do that.
Mm-hmm.
And so if you think about it, there's things that happen here. I mean, I handle all our asset management for our firm, so I know what's going on, but I'm not dealing with the day-to-day.
Yeah.
And so I can be here having this conversation with you, and I'm making money, right? And I think that's a really powerful thing. And so I think really trying to create wealth, you've got to think about how do you create sustainable income streams, and how do you also, take $1 and turn it into 10. So if you think about value add projects where we would invest $50,000 into it, we'd get an acquisition fee. So let's say we really have $30,000 into the deal, and we'd earn a $300,000 promote, right? Because we'd buy it, fix it, sell it.
Yeah.
You just took 30, you turned it into 300, right?
Yeah.
And so if you can go do that, that's also how you can build wealth, because you can build your nest egg, right? So I think if you were going to stay in brokerage, my thing would be, okay, brokerage can be a great business, right? But it's a great business for somebody who is not having to hustle each and every day for a deal. So then it's talking about how do you bring in junior brokers? How do you do stuff? How do you create a team? How do you do things where you can create sustainable revenue for yourself while not having to do everything? And then, you go build up a team, and then some firm shows up and pays you for that revenue, right? Well, then if you start a brokerage business, it doesn't take a lot of money nowadays.
Yeah.
But if they pay you for it, so you just took $1 and turned it into 10.
Yeah.
Right. And so I would think, in my opinion, if you want to create wealth, I think, real wealth is created by equity and owning something and having a piece of something and sustainable cash flows. And so that's what you've got to think about.
Yeah.
So being a sole person in brokerage, is that a good way? You can do well. I mean, I know brokers who have done very well.
Yeah.
But I've known a lot more people that have done well, on the joint venture operating side of the business.
Yeah.
Because they've either been able to create sustainable revenue streams, or they've had big pops where they're taking $1 and turning it into 10. And so, for somebody like, let's say yourself, I would say you want to think about how do you, leverage other people? How do you leverage something and turn it into something? And that's really where you can create wealth in our business.
I was asking in general, but you were speaking directly to, I love that.
Yeah.
I feel like I had a therapy lesson.
Yeah, of course.
I appreciate that.
Yeah.
I know, but we got to wrap up soon. So before we wrap up, I want to talk one more thing.
Sure.
And I think to end it, really, I'd want to know, John, for you, what's next? What are you excited about? Where do you see the future of Waterford? Where do you see the future of yourself from a time perspective? Because that's all we got. You realize the older you get, the more it's time. So what does that look like for you?
It's interesting because it's obviously, it's kind of a weird market right now. I've said this, and where it's weird is so different from the last big cycle that I was in, which is the GFC, where we were in such a bad economic recession.
Yeah.
This one we necessarily haven't been. Obviously, at some point we maybe could go into one. I don't think even if we did, it would be close to the GFC. I mean, that was really hard. But this cycle is also weird from the standpoint of you have different product types that are functioning very differently from each other. Everything's been decoupled. You have markets that are performing very differently from each other from the regulatory risk perspective, like we talked about. And so it's a very interesting kind of hard time. I think where I get excited is that you know, just like the GFC, I just had this conversation with somebody. If you think about our business is a younger person's business. It takes a lot of energy, right? It takes a lot of drive and motivation. What happens in these cycles is there's a shift at the top level. And I've already seen this shift happening where you're seeing brokers move shops, people doing things, and all this change is happening. That's what gets me really excited is I candidly don't know where this market's going to be in 5 years. I think Waterford is going to continue to lean into affordable housing and workforce housing. When you're a joint venture operating partner, I think this business is also going to a place where you have the big, huge CBRE, to use brokerage, CBRE, JLL, Newmark. Then you have the barbell on the opposite side. We have the more niche players on the brokerage side. And you're seeing that on the equity side. You have the Blackstones, the Starwoods, the KKRs, right? And then you have the niche groups who go, we do self-storage equity. And so this market's getting bifurcated. And so I think for us, we've really leaned into, workforce and affordable housing. And that's more because we know we can't be all things to all people. And I think being niche focused is sort of the niches are where the opportunities are, right?
Yeah.
I think Jonathan Gray said they had a skit about this, like the alts are the new reality.
Yeah.
And so that's where we've leaned in. But where I get really excited is like, I like it when I don't know where we're going to be in 5 years. I like it when there's all this change because change leads to opportunity. And it's one of the things where I've been so vocal this cycle on LinkedIn. For me, the last cycle, there was no LinkedIn. And so when the cycle hit, as a younger person, I think I was, 27, 28, in grad school, it was like, you weren't hearing a lot of what was happening. And it was sort of like, you felt very alone. And I also felt I was, not depressed, but it was a really hard because you were like, man, the market sucks. I thought I had done all the right things. And what the irony was, it was the best thing that could have happened in my career. And if somebody just would say, hey, John, change can be good. There's going to be all this opportunity that comes from all this dislocation. And a lot of older people are going to get out of the business. And you're going to have this path and runway from 2010 to 2022. If I would have known that in 2008, 2009, I would have been way happier. And that's why I've been so vocal on LinkedIn.
Yeah.
It's like, yes, this change is hard. Yes, there's some groups that are getting crushed by it, but I actually get really excited about it, right? And I think, on a macro level, when you think high level, I don't know what's going to happen in 5 years. You asked me about office buildings. I have no clue what's going to happen to office buildings. You happy with LA multifamily? I have a sense, but I actually really don't know. And I get really excited about that, right? Because I look at that and go, in 2019 and 18, when it was like everything was up, it was hard. It's hard, but it's in a different way. And it's like, I'm excited to see where we are in 5 years. And I'm excited to see the new equity groups that get formed and the new players that get formed and the new opportunities. And so that's what really gets me excited and now as we've gotten farther into the cycle, we're closer to that change, right?
Yeah.
What was really hard about 22, 23, even 24 is like, well, we're not in a cycle, everything's fine. Now it's people recognize, okay, it's here. And so you're starting to see more distressed trades. You're starting to see more stuff happen.
Yeah.
And that gets me excited, right? And who knows where we're going to be in 5 years?
I literally couldn't agree with you more. It's and I think it's part of who we are as people because I look forward to difficult, challenging things because I know I'm willing to deal with the pain that comes with hard things.
Yes.
I look forward to knowing that no one else is willing to do what I'm willing to do to make this happen.
100%.
And so when that opportunity presents itself, when that challenge, the changing of the markets, when things start dislocating, I get excited because I know that we're going to do, we're going to do whatever it takes to make sure that we can take advantage of this change.
Yeah. We have that mindset, right? We talked about this on our pre-call. You have a mindset that says, right? And that's what it really takes in real estate. You have to have this mindset that says, I will push forward. And what I love about real estate is, we were talking about sports, right?
Yeah.
You think about LeBron James. Obviously, he's an unbelievable basketball player. I was at the Laker game last night. I mean, he's crazy. He's 40 years old.
Yeah.
He was born with some gifts, right? He was born with some physical gifts where I never would have that. When I think about real estate, I think about the people that are successful. I know men, I know women, I know all ethnicities. I know short, tall, skinny, fat. I know there's a whole range of it. I would tell you there's a universal thing though. The people that I've known that are really successful, they have that grit mindset. They have that mindset of exactly how you just described it, where I would tell you, hearing that from you, I go, I got no worries that you're going to make it through this cycle and thrive in the cycle. And it's that mindset of, I'm going to just keep grinding. I'm going to keep going in the face of adversity. That's what I learned during the GFC. I got a lot of confidence from being able to make it through a cycle, sort of a badge of stripes, right, so to speak, or badge of honor. And I think those are the type of people who make it in this business, that look at the challenges and go, okay, I'm going to make less money. I'm going to do this. But you know what? I'm going to show up. I'm going to give the same effort, and I'm going to keep grinding. And some days it's going to feel like I'm pushing a huge boulder up a hill. But you know, at some point, like, you have that self-confidence to know, and there's the historical precedent to know, trust me, at some point the ball will go down the hill. And at some point you'll be rewarded with that. And so that's where I get excited about this market, is because I know it's going to weed people out, and it's going to create these opportunities, and it's going to take that grit to be able to get through it. But, you know, I've done it before. We'll do it again. And, you know, to people who are younger, who are going through their first cycle, I say this all the time. Like, my advice is just one day at a time, keep going, figure out a way to survive, and you will make it. You will thrive. And at the end of every bad market, there's a great market. And so, and you sometimes don't know that, right? In 2009, I just wish somebody had told me that, because I was so down in the dumps, not realizing there was going to be this great 12-year cycle in front of me where I was going to learn and grow and make money and do all these things. So it can be hard when you're in the eye of the storm, but if you have that grit mindset, I think there's going to be a lot of opportunity, and I'm excited. Like, it's going to be fun. And who knows, again, 5 years from now, we can have this conversation and go, who knows where we'll be. So I'm excited.
John Drachman, everybody. John, thank you for being here.
Of course. Thank you so much for having me.
Awesome, dude.